Hi, I'm Kelly ZITLOW. I've been helping people with VA home loans for over 25 years. Veterans are often asking me about VA loan rates. Today, we're going to talk all about VA rates and how they work. Be sure to stay to the end when I reveal my #1 top tip for how to get the best VA loan rate. Trust me, this is good. You're not going to want to miss it. Before we get started, do me a favor and subscribe to this channel. I have a true passion for home loan education. I know, kind of crazy, but seriously, I do, and would love for you to subscribe. It's been an honor to work with veterans, and thank you for your service. All right, let's do this. A couple of quick reminders before we get into VA loan rates. The VA loan is a government-backed loan that helps service members, veterans, and eligible surviving spouses become homeowners or refinance. VA loans can be used for a purchase or a cash-out refinance or a VA rate reduction refinance. You'll want to make sure you're working with a VA-approved mortgage lender. All right, #2, who's eligible? You may be eligible if you have served 90 days of active service during wartime, or you have served 181 days of active service during peacetime, or you have served 6 years in the National Guard or the Reserves. Or if you are a spouse of a service member who died in the line of duty or as a result of a service-related disability. Okay, so now let's get into VA home loan rates. All right, so how are VA home loans set? So what's important to understand is that how all mortgage rates are set, right? And they are driven by mortgage-backed securities. Now, VA has their own type of mortgage-backed security, but VA themselves do not set interest rates. And I hear that all the time, that people think that the VA sets rates. They don't. The secondary market sets rates, as do individual lenders. So it is really important to know that the mortgage-backed security market together with the lender is setting the rate for that particular day. And interest rates right now, they're very volatile. So they're going to change sometimes every day throughout the day, much like a stock. So VA loan rates are set by mortgage-backed securities and by the individual lender. All right, so other things that do impact the VA loan rate are, those could be credit score, those could be debt to income ratio, loan to value, and whether you have a funding fee or not. As a reminder, unless you have a service-connected disability, the VA is going to charge a funding fee, and the funding fee is set by the VA and based on down payment. So while that funding fee is financed into the loan, it is still considered an APR fee, which means that your APR on your loan, if you have a funding fee, is going to be higher than if you don't have a funding fee, right? So what is an APR, by the way? I get this question all the time as well. So APR stands for annual percentage rate. Be sure to check out my video on annual percentage rates, but in theory, it's going to take some of the closing costs, amortize those over time, and give you the annualized percentage rate of the home loan. That is not the note rate, it is a different calculation. All right, VA refinance rates. First, it's important to know that there's really 2 types of VA refinances. The first one is going to be a VA IRRL, and essentially that stands for interest rate reduction. And the cool thing about the VA rate reduction is essentially, as long as you are meeting the VA requirements, and there are a few, that you absolutely can drop your interest rate without having to jump through a million hoops. The VA also reduces their funding fee on a VA rate reduction refinance. Now, the interest rates, again, are going to be driven by lender, but that is a very streamlined type of refinance. An appraisal isn't required. And again, you're not going to have to do the full qualifying type of scenario for a VA rate reduction refinance. But you have to currently have a VA loan. Sometimes I have people calling that want the VA rate reduction refinance, but they have a conventional home loan and they're refinancing into VA. So that won't work. The second type of VA refinance is a cash out refinance. Now, the VA currently is allowing cash out up to 90% of the appraised value. This is going to be a full qualifying refinance, and the interest rates and the cost of the finance fee will be different when compared to a VA rate reduction refinance. You may be wondering why the rate will vary by lender, and that really comes down to risk for the most part. So why does credit score, why does debt to income ratio, why does loan to value, why do those impact the overall interest rate is really because if somebody has a lower credit score or a higher debt to income ratio, or they're putting less down, then from the lender's perspective, that would be a higher risk loan. So while the VA loans are backed by the federal government, there is still risk involved from a lending standpoint. So that could be why, if your credit score is, let's say, under 600, and maybe you have a friend or a coworker and their credit score is above 700, the terms that are being quoted could be different. Okay, so now for my number one tip, how to get the best VA loan rate is, it's all about credit. So think about what you can do to maximize your credit score prior to actually going through the home loan pre-qualification process. And these are like basic kind of things. So one, keep your balances on your credit cards at 30% or lower of the limit. That's going to help to maximize that credit score. It could also help your debt to income ratio, which again could impact your interest rate. The other thing is, if you have collections, don't plan on paying those until the lender looks at your credit report. There's a misconception out there that if you pay off an old collection account, that it could actually help you, right, and increase your credit score, but that's not always the case. The way that collections get reported could absolutely drop your credit score. So don't pay off any old collections out there until a lender looks at your credit report and gives you guidance on what to do and when to do it. And then lastly, just continue to pay your payments on time. So remember that you're not actually going to get a derogatory mark on your credit profile until that payment is 30 days or more past due. That's the point that it reports to the credit bureaus. That's going to hit your credit score. Also think that if you've had life happen and maybe you have had a 30-day late payment, the longer you get away from that late payment, the better that your score is going to be. So if you had a late payment 2 years ago, it's probably not really impacting your credit score much, but if it was just last month, it's going to have a really big impact. And when we talk about credit, it is so confusing, because know that there are so many different credit algorithms out there that drive different credit scores. So as consumers, when we go online and we look at our credit score, the algorithm that's driving that particular credit score is not the same as it is when a home lender actually pulls your credit. So if you are thinking about purchasing or refinancing, you absolutely want to work with a VA approved lender and have them pull your credit, because it's going to be that score that you're going to be working with for the VA loan rate and the VA loan approval. So that's it. Now you know how VA loan rates work. Remember, you'll want to work with an experienced VA mortgage lender and reach out to them to find out what your specific VA loan rate would be based on your situation. In the meantime, if you have any questions, please comment below. And don't forget to like, share, and subscribe. See you next time.